Now today I have added more shares of UnitedHealth Group to the portfolio. It is one that I already held and have added more shares today. We're going to discuss in this episode what is so good about this company, the metrics, taking a look at the performance as well as running it through into our valuation model, getting to our intrinsic value and our acceptable buy price given our investor margin of safety. We're also going to take a look at how the company has increased their top line year over year, as well as look at their balance sheet, a quick health check, total cash versus total debt. We're going to compare them to some of their competitors in the industry. We have UnitedHealth as well as a few other well-known. We'll also take a quick look at how well they've performed versus the S&P 500, whether or not it's just better to put that money into essentially an ETF. We'll also look at what the institutions are doing, whether they are buying or selling. And as always, we will run through the important financial metrics, taking a look at the numbers of this company and why this is one I have been adding. So firstly, it is in the healthcare industry. We can see these shares are trading around $520. And year to date, they are down pretty much flat in my opinion. And we can see they are essentially mid to the upper end of the 52-week range. Now, they do offer a yield of 1.45%, and we will touch upon that when we look at the metrics, but they are a very strong dividend growth company. And over the last 10 years, we can see you would be up around 594% on your position without those dividends reinvested. So let's take a quick look at some of the numbers behind the company. Now, total revenues, what we look for is around 3 to 7% growth year on year. December 2018, $226 billion on the top line. December 2022, $324 billion. So we can see in actual fact they have been growing very, very strongly over the last 5 years, and we'll shortly look at the last 5 years and 10 years percentage-wise too. Now, year on year, we also see increases to their top line, which is very positive. They are always increasing. And on top of that, based on their trailing 12 months, we expect to see a very strong increase to 2023 at around 10%. And as always, do click on that subscribe and bell button if you want to be notified of when they release their annual report, and we can break that down. Now, how does the bottom line net income compare? Well, 12 billion reported in 2018, 20 billion in 2022. So they are also increasing their bottom line very rapidly in similar fashion to their top line, and we can see year-on-year increases to their bottom line. 2023 is expected to be more of the same. So they're increasing both their top line and their bottom line very strong. What does the balance sheet tell us about this company? Total cash versus total debt. We can see in 2018 around 11 billion of cash sitting on their balance sheet. Latest quarterly report, 39 billion, so nearly 4 times growth in their cash position on their balance sheet. And when we compare that to essentially their total debt, what we can see is their total debt has also increased around 36.5 billion to 63 billion. So we'll keep an eye on that when we look at the net debt to EBITDA metric very soon. Now, in terms of some of their competitors in the managed healthcare industry, we have UnitedHealth, we have Humana, as well as a few well-known others. Now, year to date, we can see UNH hasn't been the best performing. In fact, one of the middle of their peers, up around 2%. We have here, as you can see, MOH up 12%, HQY up 8%. So the industry as a whole, some have performed negatively, while some have, in fact, if not all, below S&P 500. So when we expand that to the last 5 years, what do we see? Well, UNH, one of the better performing, up 131%. So that is positive to see. MOH, the best performing, up 211%. But as we always say on the channel, we never look at past performance as an indicator for the future. Now, something just to really bring up as a new metric is comparing it to the S&P 500. It is quite an expensive stock if you look at it purely on the price basis, over $500. Someone may say, well, why did we not just essentially invest in the S&P 500? Now, if we compare it to the performance, we see the S&P up around 25% year to date on a total return basis, with the year pretty much coming to an end. Over the last year, we see the S&P up 25 with UNH essentially flat. And when we look over the last 3 years, we see UNH has outperformed the S&P 500 quite considerably. And when we extend that over the last 5 years, again, we see a very similar story. So we can see over the last 3 to 5 years, that UnitedHealth has outperformed the S&P 500. But as always, it doesn't necessarily mean that over the next 5 to 10 years, it will happen again and we will see the same story. But personally, this is one that I am adding to today, and I do also hold a few ETFs, so that does cover me from the risk side in terms of holding the index as a whole. Now, when we take a look at what the institutions are doing, we can see 86% institutional ownership, around 56 billion worth of outflows by these institutions over the last 12 months. But when we compare that to the same period, we see a significant more inflows by these institutions. And with this graph, we can note two things: a lot of institutional inflows in Q2 of 2023. But other than that, when we do look over the last few years, quarter by quarter, there isn't that much buying or selling by the institutions. Yes, there are some every single quarter, but this isn't one that they tend to essentially trade. It is one more that they essentially do hold over a long period. Now, when we take a look at the metrics, dividend safety score 99, very safe, just under $500 billion mega cap company. Now, when we do take a look at the recessionary metrics, well, they maintained the dividend during the last recession. Positive growth, so this was above the average growth during 07-09, and they did in fact underperform the S&P with a negative 63% versus the S&P's negative 55%. Now, one thing just to mention here, when I am looking to invest, whether it's in UnitedHealth or other companies, I'm not looking to time the market with this investment. It wasn't trying to add this company at the lowest point, trying to time it so that by next year this will have been the maximum gain that I could have obtained. But when I'm investing, I'm looking for 10 years, 15 years, or even 20 years or more, and I'm willing to bet that UnitedHealth will be significantly higher in 10 years than it will be priced at today. Dividend growth, well, double digits in June 2023, love to see that. 17% over the last 5 years, 40% over the last 20 years. Name me one company or someone who has received a 40% increase to their salary year on year over the last 20 years. Absolutely phenomenal, and could possibly be the best dividend growth company we've seen so far. 13 years of consecutive increases. And now when we take a look at dividend yield theory, remember, it states that the company is undervalued when the current yield sits above the 5-year average. So right now we can pretty strongly argue that it looks to be reasonably valued per that model. But as always, we don't look at any of these models in isolation and draw conclusions towards the end. Forward PE, well, 19.2 versus the 5-year average of 19.8. Again, you can argue reasonable valuation. And it does currently sit slightly higher than the healthcare sector PE at 17.8. Now, when we do take a look at these metrics, as always, free cash flow over earnings, which is susceptible to manipulation by management through accounting. Below 60% is my preference. It means, in my opinion, that the lower this is, the more chance management will offer those double-digit increases. Now, it has been below 30% over the last 10 years, and in fact, 2023 is expected to be more of the same at 25%. So I do see another strong double-digit increase to the dividends in 2024. Free cash flow, well, beautiful sight to see. Nearly consistent increases year on year, and in fact, around 4 times growth over the last 10 years from $5.65 to $25. 2023 expected to be $28.40. Now, sales growth, nearly double-digit increases every single year to the top line. 2023 not expected to be any different. 14% expected to that trailing, well, expected to effectively the sales number. Now, if you want to hear the numbers or see the numbers, 122 billion worth of sales in 2013, 324 in 2022, 360 expected in 2023. Now, obviously, as investors, we love it when companies return excess cash to our pockets by doing share buybacks. I wouldn't say that UnitedHealth do the most frequent or consistent share buybacks, but over the last 10 years, we can see that the shares outstanding figure has decreased, so it is a welcome bonus to dividend growth investors in terms, or in fact, on top of those double-digit increases we've come to see and love. Now, ROIC, remember, we're looking for 10% or more. It shows us that management are able to effectively allocate their capital. And we can see that right now, nearly touching 20% every single year. 2023, in fact, expected to be 20%. So a very strong sign for management and their ability to operate the company effectively. Operating margin does leave something to be desired. We do want to see 12% or more, and we can see that they've been consistently around 7 to 9%, with 2023 expected the same. So it is one thing, or one of the metrics, if not the only metric I would like to see UnitedHealthcare do focus on to try and increase. Free cash flow margin pretty much traveling around that 5% year on year, although the last few years have been very nice, with 2023 expected 7%. Net debt to earnings before interest, tax, depreciation, amortization, the EBITDA, remember, shows us two things: company strength, company balance sheet strength, in fact, as well as the dividend safety. Dividend safety score of 99, we can see why. These show us the number of years it would take the company to pay off all of their debt net of cash on hand. 1.04 in 2022, expected in 2023, 0.52. So this is one of the best balance sheets that we have come to analyze, other than those like Chiro, for example, that we see that have zero net debt to EBITDA. So this is very, very strong for UnitedHealth. So that is in terms of the metrics about what we love about this company. Again, the healthcare sector isn't going away anytime at all, in my opinion. In fact, the population always ages. We have a lot of old people, in fact, even younger people who need healthcare insurance. So personally, this isn't a business that I think is dying, and I think is one that will continue to grow. And if I had to bet, I would say that it will continue to outperform the S&P 500 on a much longer term scale. So it does depend on what your investing time horizon is. Some people will be looking at a few years, some people will be looking further out, 10 to 20 years or more. Now let's jump into the valuation model. As always, if you enjoy the content values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio, or those even on your watch list. Now, typically, the first model would be Graham's valuation. As we mentioned, UnitedHealthcare, this company is increasing those top lines nearly double digits every single year, so it wouldn't be relevant. So let's jump into the first model. We have the multiples valuation model, companies in a similar sector and size. Remember, we analyze these on the 5-year basis. We get the average P multiplied by the earnings per share of UNH to get a stock price based on this model of 380. Now, when we take a look at that, we can see that is well below the 52-week low. So based on that one model, UNH does seem to be overvalued. But bear in mind, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. Dividend discount model, pretty perfect in my opinion. We see the yearly dividend increases well above 10%, so double digits every single year. Average 15.89, so forward looking, I have gone 6.75. A lot of people may say that's too conservative. As always, grab a copy of the model below, play around with these numbers, and you can get to your own estimates. So this comes to a DDM of 642. Now, when we take a look at that, that is pretty much above the 52-week high, and we can see even above the all-time highs, which currently do sit around that 550 mark there. So, undervaluation based on the DDM. Now, on the DCF model, discount and cash flow, where we have the free cash flows year on year, average growth rate 17.7%. We have gone for more pessimistic, more conservative at 10%, lower than the previous year as well. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $793. Can already tell you, well above that 52-week high, some strong signs of undervaluation in the current market to UnitedHealth. Now, when we take a look at the intrinsic value calculator, remember it is just the average of these three models we have gone through for today's episode. And as always, if you do enjoy the content and values being provided, do smash that like button and hit the subscribe and bell button so you are notified of these as they drop. Margin of safety, as always, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. For me, I could argue that UNH does hit all of those three criteria, but as always, if you do want to be a bit more conservative, you can go higher. At 15%, it is around $5 to $6 shy of the current trading price, so you could argue it is near a 15% margin of safety. For me, around this current price is one that I was willing to add, and I did add today. So you can see for UNH around a 15% margin of safety. What do Wall Street say? Well, as we can see here, they believe that to effectively be around a 15% upside to the current trading price over the next 12 months. So as always, in conclusion for UNH, it is one I added today. We can see it has around a 15% margin of safety based on our estimates and judgments, with Wall Street expecting around 15% upside over the next 12 months. As always, do your own due diligence. As I said, this isn't one that I'm expecting to suddenly go up 10, 20, 30% over the next few weeks or months. It is one that I've added that I believe in 10, 15 years or more, this share price will have appreciated in value at a very, very high rate. In fact, I believe right now higher than the S&P 500, but that is just one part of my portfolio alongside other ETFs that I do hold. As always, let me know your thoughts in the comments below. Is UNH one that you've added before? Is it one you're looking to add? Or if it isn't, do let me know your thoughts. As always, if you enjoyed the content, smash that like button, hit the subscribe and bell button so you are notified of these videos as they drop. And don't forget to click on that pinned comment below where you can grab a copy of the model and get to the intrinsic value and acceptable buy price of companies in your own portfolio based on your own investor margin of safety and on your own estimates and judgments. As always, have a great day and catch you on the next episode. Take care.